Welcome to Oregon Cash Flow Pro. My name is James Barber. Appreciate you joining me today. We are going to be looking at year 6 update on one of my IUL policies. Actually, 3 of my IUL policies. They're all from the same carrier and they update right about the same time. So we're going to provide that update. I do an update on these every single year. So you can see my year 5 update. We'll put that link right up here if you want to see what it looked like last year. It got a little bit better this year. IUL haters are not going to want to see this. It's a well-designed IUL policy that's actually doing well and outperforming the original illustration, as you're going to find out. So we're going to look at where it's at today. What was the original projection and how did it compare to last year also? Let's start here with last year. This is from last year's video. I'm just going to show you a little bit of this. On my particular policy, we were at $31,773. And you can see our growth since inception was a weighted average credit of 6.62. We made about $5,200 in interest. Not too bad considering the size of this policy. Let's look where it's at today. You can see we're at $45,770 in cash value. And our average credit now up to 7.37%. We did have a good year. We're 100% in the S&P 500 with a cap index option, and we capped out all year at 9.25. 9.25, not ideal, but it's good enough that we can get good credit in here. If I scroll down just a little bit, you can see that we're using the systematic allocation, which actually reduces some of my gains for this last year. We're getting less credit because that money is sitting in this systematic allocation account. It hasn't been allocated to the index options yet. So it's unfortunate, but we're still outperforming currently. Those will make it into the index allocation over the course of this next year. Now, where is this policy at? We're at $45,770. We've paid into this policy $42,000. So we've passed the break even. We've just completed year 6. We're just starting year 7 in this policy. We hit our break even after 5 years. We hit our break even in last year's video, I believe. So overall, I'm pretty happy with this. Here's the original illustration when I first bought the policy. You can see year 1 and our projected values. Year 5, which was last year's video, these are end of year values. We were at 31.7, so we were beating last year's by a little bit. And this year, 38.945, we're beating that by a little bit. If we want to consider this number, the 38.945, the number that we see when I showed you the actual account includes the 6,000. So if we add that to that, it would be 44,945 as the projected value. But then we also have a load fee that comes out, load fee of 6%. So that's another $360, almost $400 off. So if we hop back over to here, we have 45.7. So if we add in the load fee to this of 300 and something, we would actually be at 46,000 minus the 6,000 of what we paid into it. We would actually be right at about 40,000 in growth. So we're beating this original projection by a little over $1,000, and we're 7 years into it. That's not too bad. I'm actually pretty happy about that. Here is our current illustration. I just ran this in-force illustration. We're putting in the same amount of money that we had assumed. Now I'm assuming we pay the loan back. I do have a loan outstanding on this. We can see that the difference here between the surrender value and the accumulated value is the outstanding loan. Now I get to borrow at 4.6% interest, and I earned 9.25% all year. So we're getting some nice arbitrage. Again, you IUL haters, you might want to close your ears, cover your eyes. This is not something that you want people that you want to hate the IUL to see. We don't hate the IUL. We actually are pretty happy to have these things happen. We're paying 4.6 and we're earning 9.25 on those same dollars. Now, we don't get that every year. That just happened this last year. But you can see on average, I'm earning 7.37 since inception. And my loan rate has always been 4.6 or lower since we started this policy. So I'm pretty happy with that. Let's take a look at one of my other policies. This is one of my daughter's policies. We're at $13,156 in accumulated value. We've already made this next year's payment. So total premium paid $12,700. We're past the break even in all of these policies now, which is what we would expect. And in our final one, we're at $12,200 and we're in it for $11,821. So past the break even on that one. I think we passed the break even last year, but it was just barely. And when we made our premium payment, the load fee came out and it made it look like it pushed us just under break even. So now we're above that even after the load fees come out, but before we start earning any credits for this next year. This is showing just the credit for this year. It's not since inception. Let's take a look at how this one has done since inception. We're at 6.92. Now, the other thing I like to look at with these things is, even if I wasn't getting good credits like I'm getting right now, what does it cost me to own this? This was a well-designed policy. These do not have large expenses inside of them. Here's the policy charges ledger. You can see my expenses in total, $400. We have $46,000 in here. Next year, projection, $54,000 in there, and my expenses, just under $1,000. 364 of that being a load fee. This is what we like to see in a well-designed IUL. We like to see our expenses be a low percentage of the overall cash value a number of years into it. Now, when we first started, it's going to be a high percentage in the first couple of years compared to the total amount of cash we have in there. But if we're max funding our policy, that's going to drop very quickly. And this was not a very big policy to begin with. This policy, the carrier allows us to do a 3-to-1 blended design, base face amount, and we can blend in some additional supplemental term insurance that doesn't pay anybody a commission. That's how we keep these costs really low. So we can do that here on a very low dollar amount. So this policy was designed to not fund at a very high level, and we're getting some really good performance out of it. So you don't have to have a policy that's funded at $50,000 or $100,000 a year just to make it look good in relation to the expenses. We can design them at all kinds of levels. That's it for this update. If you have any questions about what you just saw, put it in the comment section below. If there was something that I missed, something that maybe I didn't provide clarity on, definitely let me know, because the whole reason I do this is so that you guys can better understand these policies. You can follow along on the journey with me, the ownership experience with this policy. And other than the cap rate projection on this one was an 11.25 cap on that S&P option, and it went down. I think it went down to 8.5 at one point. Now it's back up to 9.25. But I'm still doing good in relation to our original projection. And I just wanted to show you quickly, in that original projection, this right here is why we have such low costs. We were able to design a policy with very low target premium because we did that blended design. Thanks for joining me. We'll be back again soon with some new information. So hit that like button, subscribe to the channel if you appreciate what we're doing here. I wish you all a great New Year's.
Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.